Hello everyone, thanks for taking the time today to join us for this Q2 update of the AJ Bell MPS service. My name is Brennan. I am the Head of Investment Management at AJ Bell Investments. That covers the MPS and the funds that we run. So really today, going to give you a run through of what's happened in the markets, how that's driven sort of portfolio performance, and just a little bit of an overview as to what's happening at AJ Bell Investments as well as a business, to give you the confidence to continue using us. So AJ Bell Investments, we're actually just about to come up to our 5th anniversary. So in August 2016, we launched our first set of MPS portfolios. And over time, that range has evolved, really focusing on offering choice to you guys. So that's both funds and MPS, different implementations. You can see that fully passive to an active to our in-between solution, our blended solution, which we call the Pactive MPS. And then obviously we have fund solutions as well. And Ryan did give you an update last quarter on the launch of our newest solution, the responsible funds and MPS. Since we last spoke, our total assets under management have grown from 1 billion to 1.4 billion over the last quarter. So thanks again for your continued support. We really couldn't do this without you. So really glad to see continued adoption of the service and in particular good flows across all the solutions. So first of all, we just have a quick look at the absolute return of all the different portfolios over the quarter. So I think as we get into the details, what we'll see is that it was a positive market for both equities and bonds. And what that means is, given the portfolios are constructed as a mix of the two, that we saw good performance across all portfolios, including the low risk portfolios. But given equities did better than bonds, it's no surprise to see those higher risk portfolios such as MPS 4, 5 and 6 doing slightly better in absolute terms versus portfolios 1, 2 and 3. If we look at the income solutions, again, we'll get into the details here. After a really good period for sort of value strategies over the last year, this quarter did see a bit of a reversal. So again, still good positive numbers, but slightly behind the growth equivalent. When we start looking at those longer time periods, we can start to see the effects of, I guess, first of all, it's been a very strong market over the last year. So 12-month numbers are above what we guide as our sort of higher end expectations, especially for those higher risk portfolios. And then obviously over 3 years and since launch, which for most of those portfolios, 1 to 5 is almost 5 years now, and then about 3 years for 6, 1, 2, and income 1 and 2. You can see, as I say, good positive capital growth and dividends as well. It's a very similar story for the active portfolios. Again, we saw active experience really good returns since the bottom of the market in March, April last year, with real strong performance of small cap style value styles, whereas this quarter saw a return to, I guess, the market environment we saw pre-pandemic, which was about focusing on large cap technology stocks, for example, doing well. So we were pleased to see actually the active portfolios, the active MPS performed pretty much in line with the passive MPS over the quarter. And as I say, over that 6 and 12-month horizon, it actually outperformed slightly compared to the passive portfolios. Again, those portfolios have now gone through their 3-year mark, so we're pleased to see those continued good numbers on those longer time frames. We launched our Pactive portfolios 2 years ago now, or just over two years ago now. So these are a blend between the active MPS and the AJ Bell fund, which is largely passively implemented. this is to give you that kind of balance between active management whilst also focusing on keeping costs low. Again, given that active and passive performed pretty similarly over the quarter, it's no surprise to see the Pactive portfolios again delivering similar numbers. And again, we're starting to see that flow through. So that continued positive numbers over the quarter is helping give you strong 6 months, 12 months, and since launch numbers. So I touched on some of the trends as to what's happening in the market and how that drives our performance. But hopefully this dial, as we like to call it, will just give you a bit of a flavour as to, I'd say, what the trends are in the market and how that drives portfolios. And then I'll touch later on how we're positioned for that. So the top set of dials are what's happened over the quarter, and the bottom set of dials just a slightly longer period, so over 1 year. And the top dials it's a plus and minus 10%, and the bottom plus and minus 25% because of that longer time period. So the first dial we look at currency moves. So again, probably back to that point of it being less of a value-focused rally over the quarter. We saw fairly neutral currency performance. So the pound versus dollar was pretty much flat. I think it was 0.1% when I look at the numbers. However, that obviously is different to the trend we've seen over a longer period. So since the market bottomed out, and certainly since 12 months ago, we've seen the pound rally hard against what you would call risk-off currencies, so safe haven currencies. So 10% up against the dollar, but also good strength against currencies like the Japanese yen and the Swiss franc. Now, when you have a UK or sterling-based portfolio, obviously when the pound strengthens, that's actually bad for any holdings you have denominated in overseas currencies. And when it goes the other way, when the pound weakens, as we saw, for example, in 2016 after the referendum, that's actually good when you convert your return. So a portfolio like ours, where there is a good portion in international assets, that as I say, held back returns slightly, but obviously still good given how strong markets have been. The next one we look at is basically looking at our bond positioning. So here we've looked at shorter dated bonds, so bonds that are due to mature in the next 1 to 3 years, and we've compared those to the performance of longer dated bonds, so those that with more than 10 years still to go until they mature. And again, this is just to try and create a measure for how the market is seeing interest rate risk, inflation risk, and again, if they're worried about market shocks, where obviously yields tend to fall in that environment, or if they see more of a growth environment. So again, since the market bottom, when people have been worried about inflation and the end of quantitative easing, we saw short duration performing really well, outperforming those longer bonds. But this quarter, again, we've seen a revert back to type as to what we've seen, I guess, really since the global financial crisis, of long dated bonds doing better, delivering slightly higher returns. Again, within our portfolios, we do tend to have a shorter duration or a shorter maturity position. We do worry in the long term that the bonds eventually will go back up to previous levels. As we've seen, as I say, not this quarter, but previous quarter, when that does happen, it can lead to significant losses for long-dated bonds. But again, when the market moves towards long, it does sometimes leave us a little bit behind versus peers. The next one is, I guess, a more broad measure of bonds versus equities. And here, this is really the important point, that if equities are significantly outperforming bonds, then our higher risk portfolios are going to outperform. And this is really important when you look at the context of our returns, because obviously we show on our fact sheets how the portfolios have performed versus the IA sectors. Now, the IA sectors are a very broad measure. So, for example, if you took the one where our MPS 3 portfolios sit, which is the 40 to 85% share content, obviously, if you're in the close to the 85% mark, you're going to have done better than the one close to the 40% mark. Now, our portfolios, as you know, are tied to the Dynamic Planner Risk Target Managed Solution. So we show the IA sectors more as an output rather than something that's integral as part of our performance. But it is always important that when you're looking at short-term performance of portfolios against those IA sectors, that you do think about if equities or bonds have done better. The next measure we look at is value versus growth, sorry, value versus quality. So here we're looking at the performance of companies with, I guess, lower sort of price metrics. So the typical ones tend to be things like PE, so price earnings ratios, price book, so price divided by the book price, cash flow metrics, etc., etc. And the idea here is companies with lower metrics, so less expensive, are deemed value stocks, whereas quality stocks tend to be ones where they've got really good metrics such as balance sheet quality, usually good return on equity, but that quite often demands a higher price premium. So here we're comparing those almost higher rated stocks to those lower rated stocks. Since the global financial crisis, again, it's really been those quality growth stocks that have been in favor. However, over the last 12 months, we saw really strong bounce back in those value stocks, which really helps the active space, given they are focused towards those value stocks more typically. However, this quarter, we did see that revert back to type. You can see a strong performance for those quality stocks driven by areas such as technology, healthcare, for example, and we'll get into that, which then means over that 12-month view, a bit more balanced. And then we look at our, I guess, bond positioning. So again, we tend to be a little bit more favoured towards, I guess, credit rather than government bonds, and that includes things like investment grade and high yield bonds. Again, when the risk on mode is on and when equities are going up, credit tends to outperform. So we've seen that again over this quarter and again over that 12-month period. The final one we look at is the performance of large cap stocks versus small cap stocks. Again, when large is doing well, that tends to be a good environment for passive implemented portfolios, given large stocks index. When you index, you're buying the larger stocks. So the final area we look at is small cap versus large cap. And again, when you look at passive strategies, when they're buying indexes, that tends to be focused more towards those large caps, which are included in the indices, whereas active management tends to move away from the index, so favouring those smaller companies. Again, over this quarter, we saw a return to strong performance of large cap companies. But again, over that longer period of 12 months, you can still see really good outperformance of those smaller companies, which is a good environment for active management. So really, we summarise that into a few key points. That obviously equity markets continue to drive higher, and that's really going to be your biggest driver of return. How much equities you've got is going to drive how good your returns are. This quarter has seen a bit of a mean reversion, so back to what was previously working before this bounce. So always worth thinking about that in terms of that short-term performance, but do look at that longer context. The pound wasn't really a driver of performance this time, but over the longer term, it's something that's really important when you've got sterling-based portfolios. And then inflation measures did continue to move higher globally. However, at the moment, and we'll touch on this, it is still, although we're seeing inflation ticking up, most market participants still just see it as transient and not getting out of control, which I guess is important given where shorter duration, if it does get out of control, we're well positioned for that. So we can see here over the quarter, again, just a bit more granular detail here. We'll not spend too long looking at these, that all markets tended to do well over the quarter apart from Japan. Japan, which was the best performing market in Q1, has seen a fallback. So again, you've always got to stay in context as to over that longer time period as to what's happened. We don't have particularly large Japanese positions in the portfolios, but other than that, I'd say all markets doing well. And as I've touched on there, we saw a bounce back in both quality and growth styles. So you can see there 3 or 4% ahead of the other styles in terms of performance over the quarter, coming up into double-digit returns. And then we've shown this in one other way, which is to look at the performance of different sectors. So we've highlighted in a darker red the ones we use as part of our strategic asset allocation. The one that's not in red that we do use in the low risk portfolios is utilities. That's just because obviously it's a negative number. So what you can see here is our use of sectors has kind of, I guess, given us a broad range of outcomes, which is obviously what we're trying to do. We're trying to increase the diversification in the portfolios. Despite value not doing as well, energy still had a very good quarter. Obviously, that was helped as well by good performance from some of the other sectors we hold, technology and healthcare, with consumer cyclicals being a little bit more mixed. So I guess if we look at the utilities, that's the only one that's sort of a long way behind. But it's in there for a reason. As we've seen in the early part of July, so post the quarter end where it's done much better, it does tend to do well when yields fall significantly. So although it didn't see such good performance in Q1, it's there as a diversifier in certain market situations. And this kind of points to the point I made earlier about longer dated bonds doing better. So, not a big quantum of difference, 0.5% versus 2.7%, about just over 2% difference between long bonds and short bonds. But you can see those longer dated bonds delivering slightly higher returns over the quarter. And then the final metric I mentioned was the inflation measures. So we can see here from the market bottom in Feb 2020 that certainly across the US, Europe, that inflation measure has picked up, fairly significantly, and is now above pre-pandemic levels. The UK measures actually stayed a bit flatter, but again, just seeing that general tick up. Again, as a reminder, we added US Treasury inflation protected securities into the portfolio earlier this year, again, looking at protecting from that sort of change. So basically, all that market context should hopefully help you understand the performance of our portfolios over the quarter. So as I say, positive performance for equities and bonds means all portfolios delivered positive returns over the quarter. As I've touched on, there was a similar performance for both our passive and active solutions. Again, that's a good outcome on the active side, given that return to a quality mega cap environment, which shows that our active solution really does look to blend styles. Is still, even though using active, making sure it's buying different, not just value stocks, but also growth and large cap in there. The shorter duration of the portfolios did hold back returns slightly, in particular in the lower risk portfolios, but we still saw positive performance, still positive numbers across the board. We do hold some riskier bonds, such as EM bonds and high yield bonds. Again, that helped. And then the final point is obviously all those use of sectors, again, helped, apart from the use of utilities, which is in the lowest couple of risks levels, which did see a slightly negative / flat return, but that is in there for diversification purposes. So obviously on the passive side, we use indexes, so ETFs and indexes. So I'm not going to talk particularly around individual security performance. So instead, if we focus in on the active MPS growth, we can see, as well as those asset allocation drivers, we had a couple of funds that did particularly well. So China was actually one of the worst performing markets over the quarter. It's still positive, but behind some other EM nations. However, the Chinese implementation we use, the Allianz All China Equity Fund, actually performed really well, outperformed the index and outperformed EM equities generally. So, that was a good addition, one of the newer positions across the portfolio. So, we did hold a sister fund in the MPS 6 portfolios last year, but it was added more generally across the portfolios earlier this year and has performed well. Similarly, as I touched on, it's been a good environment for smaller caps stocks over 12 months, less so over the quarter. So it's really good to see something like the Telworth UK Smaller Companies Fund outperforming, as I say, despite it being a tougher environment for smaller cap. So, you know, that's again a newer fund. It's one that we supported from an early stage. So pleased to see that doing well. And then the final fund to note on the upside is Jupiter Japan. So again, we mentioned how Japan had struggled. This one managed to outperform the Japanese index, which again means it dampened some of those losses. So, you know, a good result on the active side. On the other side, so what didn't do quite so well. So as I've touched on, you know, if you're looking at things like US smaller companies and say either smaller companies or that sort of value style, they did less well over the quarter. So a couple of examples in the portfolios: Artemis US smaller companies and JPM US equity income. And then the other one to note is that where we have a healthcare position in the passive and in the lower risk active portfolios, we use just an ETF tracker. However, in the higher risk active portfolios, we do use an investment trust, the Worldwide Healthcare Trust. So again, it does have those quality characteristics, but it does have a bit more in some, I guess, higher risk names in the biotech sector. They didn't perform quite as well as the general healthcare stocks over the quarter. So next area is just to focus on is the income portfolios. So as I mentioned, you know, in particular Q1 but also the 6 months before that, we saw a good bounce back in income strategies. However, in Q2 we did see a bit of a reversal, but that means if you look at the year as a whole, so the first 6 months of the year, you know, the income portfolios and the growth portfolios did very similar numbers. Dividends continue to be restored across the board. So if we look at sort of, I guess, February, March, April last year, we saw about a 10% cut to income dividends across the board. So we're starting to see that restored across many sectors. So I guess that's a good outcome when we're looking to deliver that dividend. We took the decision earlier in the year to reduce bond exposure in favor of equities. Obviously, as I've touched on, if equities are outperforming bonds, then that's, you know, a good outcome in the short term, obviously helping performance. It is worth noting, though, that we are going to see the risk level of the MPS 1 portfolio step up. We are just finalising that at the moment with Dynamic Planner. And as similar to the growth portfolios, no real discernible difference between the active solutions and the passive solutions over the quarter. So finally, a bit of a market outlook. So the market continues to price in that strong economic recovery. That does mean that if that does falter, we could see short-term bumps in the road, and things like higher inflation again and higher interest rates could lead to some short-term underperformance. Again, you've got to look at it in the context of how well portfolios have performed over the last 12 to 18 months from that market bottom. So we are saying, you know, 10p our expectations going forward. The value rally has lost some of its steam, but valuation gaps between those growth stocks and those value stocks remain. So there's no reason why in the long term that can't continue if trends revert back to where we were earlier in the year. Risks still remain. You know, COVID hasn't gone away. You know, we've seen in the UK things like the Delta variant do still put sort of, I guess, speed bumps in the way. So I'd probably summarize our outlook as cautiously optimistic. You know, the valuations are still reasonable, especially in equity markets, less so in bond markets. But you do have to be ready for those bumps on the way. Expect, you know, maybe slightly lower returns, but we do remain ready to react. We didn't make any changes to the portfolio over the quarter. We were happy with our positioning. Obviously, we made major changes in February 2021, but we do continually monitor both our active, passive, and Pactive solutions and responsible to make sure they remain well positioned. So keep up to date with everything we're doing on Invest Centre. That includes a refreshed quarterly report this time, which is a bit more visual. So hopefully that's a bit more useful for you guys. But thank you very much for taking the time to listen today. Hopefully that was insightful. And if you do have any questions, please don't hesitate to contact us. Thank you very much and goodbye.